All right.
Good afternoon, everyone. Welcome to the third of 3 sessions hosted by AmPac Business Capital and American Business Bank for the BPOC or BIPOC and Women-Owned Small Business Grant Program. We really thank you all for being here and thank you for the opportunity to learn together. We are delighted to bring this third of 3 sessions. My name is Hilda Kennedy, and I am founder and president of AmPac Business Capital. And so I will start the webinar as people are coming on still. I'm going to give it just a couple of more minutes, but I want to thank all of you for being here for the webinar for the third training session with AmPac Business Capital and American Business Bank for the BIPOC and Women-Owned Small Business Grant Program. We're really excited about this component of the grant because the grant is competitive. There are limited funds, but there is an unlimited opportunity for small business owners to grow and get the educational material that are available. So we're delighted about that. We will start in just a few more minutes as we're seeing people logging on and getting in place. We will start at 1:05 p.m. Again, thank you for being here. Good afternoon, everyone. It's 1:05 p.m. and we are going to get started. My name is Hilda Kennedy and I am founder and president of AmPac Business Capital. And I'd like to welcome you to the AmPac and American Business Bank BIPOC and Women-Owned Business Small Business Grant Program presentation. We are excited about this training program and the opportunity to share this growing opportunity for you as a business owner. Before we begin, I want to just share some ground rules on what you can see, what you'll be able to see. You're registered to join, and so your registration is required for entry into the grant program. And so thank you so much for that. You can rename yourself, but your registration already accounts you for your attendance as part of the requirement for the grant. We've turned off the chat feature so that you can put your questions in the Q&A question and answer function, and we will be answering your questions throughout the presentation in writing on the Q&A feature. And then in different parts of the segment, the facilitator, the trainer, will be able to answer some of your questions live. So please use the Q&A feature. I know several people have already started using the Q&A. Thank you very much for that. We'll be answering those as quickly as we can. We will be sending all of the training material out following the presentation. We also sent the participant guide that will be referenced in the presentation earlier over the last couple of days before you registered. If you did not get that, you will get it immediately following or shortly following the presentation, so please be aware of that. This session is being recorded and it will be placed on the AmPac YouTube channel, so you'll be able to go back to the presentation and hear it again as well. If you have questions about the webinar or to get additional information, you can email info@ampac.com. Please make sure in the subject line you put ABB grant and the name of your business, because we're getting so many emails. We want to make sure that we can track your email. Again, info@ampac.com. There will be a few polls that are launched during the presentation, or at least one that's launched during the presentation. Make sure that you're able to answer that. It's not required, but if we'd love to get your feedback during the presentation. So again, thank you very much for being on today. And let me tell you a little bit about today's agenda. So we'll review some of the guidelines again for the grant. We'll tell you a little bit more about American Business Bank, and Bruce Gumaner is not here. So Omar Morel, who is also your trainer for today, will tell you a little bit more about American Business Bank and their commitment to this grant and the training, why that is so important to them as a premier bank in our region. And we'll tell you a little bit more about AmPac Business Capital and the team. So you are here because you're interested, or you have applied or you're planning to submit the rest of your application for the American Business Bank BIPOC and women-owned small business grant. And the purpose of the grant is to provide funds to small businesses who have been impacted by the pandemic, and they're on the road to recovery. And we're seeking to support those small businesses in starting over or pivoting or continuing to grow as a result. The grant is limited, the funds are limited, and the grant process is competitive. And part of that competitive grant process is for you to have attended 2 of the 3 trainings that we offered and complete the assignment that was provided after each training session, and then complete all of the items on the checklist. Please note, we will not be able to consider any incomplete applications. So please look at the frequently asked questions that are included on our website at ampac.com. And that's also in the material that will be following this presentation. We will only be able to consider, again, complete applications. If for some reason you don't understand something in the application and we're unable to get back to you, include a sheet or a note indicating what your understanding of the item that's being asked, and then we can consider that in the review of the application. We are delighted that you have chosen to participate in the training, because we believe whether you are successful in getting a grant or not, this training should bring value to you and your business, and especially today's topic. So again, thank you very much for being here. I'm going to turn it over to Omar to talk a little bit about American Business Bank so that you can get to know the bank and about their commitment to this grant. Omar?
Thanks, Hilda. I'll do this part quick, as I'm sure I can't do justice to what Bruce would have shared with you. And unfortunately, he just had a last minute situation come up, so he wasn't able to join us. But American Business Bank was actually started about 21 years ago now. And today we're right about a $4 billion bank. And that, I know that sounds like a lot of money, but when you really consider that we're more of a rounding error to some of the really large banks that I'm sure you all are familiar with. We really are a bank who's never been acquired or gone through an acquisition of any kind. And so it's really an organic growth. So very similar to where you're starting. The founders of our bank, 5 gentlemen, started it, like I said, about 21 years ago, and really started it very similar to the way that all of you started your businesses with sitting around a table, putting together a plan, and then growing it from there. So we are very committed as an organization to help other entrepreneurs achieve that same dream and be able to grow their opportunity. And so that's why we've partnered up with AmPac for this program, and we're just really excited to be a part of it. So back to you, Hilda.
Thank you so much, Omar. So I want to take a little time to tell you a little bit about AmPac Business Capital and what we do. The team that's working today on the ABB grant and the training is myself, Hilda Kennedy, as founder and president of AmPac Business Capital, Richard Pillay, who's our senior VP of community lending, and Brian Kennedy, who's our entrepreneur ecosystem director, and you'll hear a little bit more about him a little later. The AmPac is a 501c3 mission-based lender. We're authorized by the U.S. Department of Treasury as a community development financial institution, and we participate as a partner in the U.S. Small Business Administration SBA programs. We participate in the SBA microloan program, Community Advantage program, and the SBA 504 program, and I'll tell you more about those. But we exist, the wind beneath our wings is to uplift communities, strengthen families, and advance entrepreneurial dreams. And that's why this program is so important to us. On the next slide, I'll tell you a little bit more about how we do what we do. We finance businesses at all stages of growth, from cradle to legacy, from startup businesses who are just getting started with some working capital needs, to those businesses seeking to purchase large commercial real estate to house their business and to create jobs. We work in partnership with traditional banks in the programs that we serve in. So our government-backed loans and our private loans range from $5,000 to some north of $30 million, depending on the project, especially if it's commercial real estate. Our SBA loans include the SBA 504 loan, which is designed to help businesses purchase owner-occupied commercial real estate or refinance commercial real estate, finance tenant improvements or ground-up construction, or finance equipment. And over our 14-year history, we've done about $750 million in SBA 504 loans, creating more than 3,000 new jobs for small businesses. Our direct lending programs include loans for working capital, inventory, business acquisitions, and then to assist with the pandemic, we did over $18 million in PPP loans, in addition to managing and administering grants for local governments. Our working capital loans, again, range from $5,000 to $250,000 through our community lending division. In addition to our capital programs, we really pride ourselves as nonprofits, not having to be beholden to shareholders, is trying to make sure that small businesses get the right fit for making their business dream come true. So we do business advising, where we're helping the small business identify a best fit lending partner and a best fit loan for their business, understanding what your need is, what your industry is, how long you've been in business, we're able to do some matchmaking in that respect if we're not doing the direct lending. We also offer an array of training programs. We do that either directly in partnership with an organization, or we refer to the myriad of partners that we have that are part of our, our stream of agreements with technical assistance and coaching partners to make sure that businesses get the support that they need. And again, our direct lending programs are always coupled with training to help our business clients propel their growth. I'll tell you, we just launched our entrepreneur ecosystem where Brian is the director, and he'll tell you a little bit more about that.
Thank you, Hilda. And great afternoon, everyone. We're always grateful to have abilities to host trainings like this. So let me tell you a little bit about our entrepreneur ecosystem. We're really aiming to build out and continue to bolster our business resource hub and community center that is the entrepreneur ecosystem. We recently did launch our digital platform for our entrepreneur ecosystem, which is our mobile app, which can be found on the App Store for iPhones and on the Google Play Store for Androids. We really aim to make sure that folks are getting access to business coaches and mentors, as well as all of the different events to really advance business acumen training made available. We're going to continue to update the app. It's going to continue to be a living, breathing space, but feel free to join and connect with people. Make sure your profile is nice and robust so people can see who you are, what you do, what you offer, so it can really be a beautiful interactive community. But we definitely want to welcome you into our digital entrepreneur ecosystem community. So jump on your App Store, jump on your Google Play Store, and download AmPac Business Capital's mobile app today. We would love to have you. Thank you.
And you've met Omar earlier, but I do want to say a little bit more about Omar. Omar not only works for American Business Bank and serves as a senior business development officer and VP at American Business Bank, but he's also a member of the AmPac board of directors and serves on the executive committee as our treasurer. And we're delighted to have him have his partnership, but most importantly, his expertise and sheer passion for small businesses and their success. And today he'll be talking about managing cash flow, a really critical component of a small business. And so I'm delighted to turn this back over to Omar to talk about this critical topic.
Yes, thank you so much, Hilda and Brian. Really excited to be here again for our third and final training. And hopefully I know we have a little bit of extra time today, so we have a lot to cover. And so hopefully this is going to be another beneficial one for you. So let's talk about what we're going to be discussing today. We're going to go through a case study that's going to kind of drive us through this. We're going to talk about the 3 views of cash flow. We're going to go back to the case study and say, well, what can our fake business owner Bob do? And then we'll kind of wrap things up and everything that happens after the training. So what are our learning objectives today? So we're going to describe the purpose of cash flow management. How do we assess a cash flow cycle and make some cash flow projections? I think that's going to be really valuable for some of you as we go through that. We're going to describe how a cash flow statement can help assess and improve the financial health of a startup. And we're going to identify some ways to manage our cash in terms, what are things that we can do as what are some of the decisions that we can make as we're managing our cash. And then, as always, hopefully you've heard me say it enough. Make sure we're going to talk about what types of technical assistance you should be seeking out. Because all of us have certain expertises, certain talents, certain giftings. And it's a wonderful thing when we can access experts in other areas that can help fill in some of those gaps for us. So hopefully this training and all of these trainings help you to kind of know what you don't know, help you to round out a little bit of your own knowledge so that you can direct your business. and it helps you identify some of those experts that can really know the finer points of what it's going to take to help your business grow. All right, so I'm going to pull Brian back in for a second, and he's going to read our case for us. If you have your participant guide, he's going to be reading along from page 4, and we're going to talk about Bob and the wired cup. Coffee, I have my cup of coffee right here. So I like Bob already. So Brian, why don't you read the case for us?
Thanks, Omar. Bob recently opened a new bakery cafe, the Wired Cup. The cafe has a great location in a small college town. To get started, Bob invested $30,000 of his own money and received a $20,000 loan from a commercial bank. Hashtag go ABB. He spent $45,000 on startup costs, leaving $5,000 to run the business. The Wired Cup is already popular with students, university staff, and neighbors. Everyone loves the coffee and baked goods. A college dean has started to order croissants for the faculty dining hall. Bob is building a great new business. However, Bob has concerns. He has not yet paid himself, and he wonders when he can. The $5,000 is almost gone. Given that his key customers are students, he assumes many will go home over holiday breaks and the summer. Questions Bob is now asking. How will he pay his bills if there are fewer customers? Will he have enough money to ramp up again in September? Should he buy in bulk to reduce costs? And will suppliers allow Bob to buy on credit? Or does he still have to pay cash? The good news is that Bob is thinking ahead. He has time to find some solutions. So as we review the Wired Cup's cash flow issues, you'll be able to apply these concepts to your own business. Thank you, Omar.
Thank you, Brian. On a totally unrelated note, Brian's actually going to be hosting Jeopardy in the future. I don't know if any of you knew that, but he's actually the one that was selected because clearly a natural host that we have on our hands here. So, all right. So we're going to launch a poll and get right into it. And I just want to get a sense for really simple poll, one question. Oh, I got to hit launch. One question, and just let us know, where are you on your understanding of cash flow? Are you a beginner? Are you an expert? Are you somewhere in between? And let's just take a few minutes and give us a sense of where the group is, so that we kind of have a feel for everyone, and we can make sure that we're addressing things correctly. Okay, looks like we got right about half of us have answered the question so far. So let's go ahead and just give us a little bit more time. I'll tell you what, we'll go about another 20 seconds, and then we'll close the poll. So we're at 60%. Can we get up to 70? 5 seconds left. All right, we're going to go ahead and end it. Thank you so much for those of you that participated. Let's share the results. So it looks like, it's about where I expected. There's definitely a percentage of you that are experts or kind of feel like you have a really good grasp on things. There's definitely a chunk of you that are saying, hey, you know what, I'm just getting started with this whole cash flow thing. And, it's a little bit of a mystery. And then the bulk of us are kind of somewhere right in between, or right in the middle, right? You've got some understanding of cash flow, but you still have some questions and you still could use some help. So this is great. This is actually a really good mix in the room. And I'm going to do something. I'm going to move my little screen over here so that I stop looking off to the right there. Different setup this week. All right, so let's jump into it. Let's talk about a balance sheet. Okay, so this is where we tend to start. And some of you, maybe some of you that were experts, were already starting to kind of put this balance sheet together in your head as Brian was reading the case, right? So what do we know about Bob's opening day balance sheet, right? Well, we know that he started it with $50,000, okay? And we also know that 30,000 of it came from his own money, okay? And we call that, let me get I get to play with fun tools today. So we're gonna go ahead and let's do the highlighter. So we know that, does that work? Wow, that's not working as well as I thought it was gonna work. So, is it because I'm on the wrong screen? Oh, that's what it is. Okay, I'm on the wrong screen. All right, so We're all learning, right? So we know that Bob started with $30,000 of his own capital. And so we call that equity, okay? So I'm going to get a little further along. Whenever we talk about a balance sheet for a business, there's three parts to a balance sheet, okay? And these things always have to equal out. We have what we call assets. That's over here. That's the left side of the balance sheet, okay? And then we have what equals the left side. So this is the equation is liabilities. That's what we owe. Oops, give my laser pointer back. Okay, lost it. That's what we owe other people, whether it's our vendors, whether it's credit cards, whether it's banks, bank loans, and we have equity. And so if we add up our liabilities and we add up our equity, our own money, that will equal our assets, okay? So we know that Bob started the business with $30,000 right there, that $30,000 of his own capital, that's our equity. And we know that Bob borrowed $20,000 from a bank, right? And so we know that's why you see there that total $3,300 that he still owes to the bank. I won't get into it, but that's our debt service. That's our current portion, plus the 16,000 remaining. That's the total 20,000. Okay, so 20,000 plus the 30, he has $50,000 of assets, or what it is that makes up this business. Okay, so a couple of things. The $20,000 note, we know it's on a really high interest rate, 14.5%. First year, he's going to be paying back $3,300. That's that 3371, I should say. That's the that piece there. And then we know that he went off and spent that money in different areas to get his business started. And that could be legal fees, right? Corporation startup work, that sort of thing. That could be things like payroll. Maybe he had to hire some folks in to get them trained up before he actually opened his doors. If we're going to make coffee, we need coffee and donuts and croissants. We need flour and coffee beans and all of that sort of stuff. So we need ingredients. We need insurance, right? Because we don't want to go and poison somebody by accident. That'd be a bad day, right? Those are what we call our current assets, or in other words, things that we're doing, but we're going to be going through those items. We're going to be using those items within the first year. And then we also need some fixed assets. And those are things that the business will be able to use over a longer period of time, more than 1 year. So what does a coffee shop need? Well, we need some kitchen equipment, right? At $9,000, it looks like. My screen's a little small. $9,000 on kitchen equipment, right? The coffee pots and the oven and the mixer, right? To make all of the different things. We have some leasehold improvements. So we move into a new space. Whether it's a coffee shop in this case or any of your businesses, maybe you need to paint some walls. Maybe you need to move a wall from here to there to make it fit a little bit better into it. Maybe you need to cut a hole and make a window somewhere. Whatever the case may be, that's what we call leasehold improvements. And then office equipment, of course, we need things like desks and printers and so on and so forth. So all of these things, all of these different areas that we needed to spend money on, or Bob needed to spend money on, is what makes up our total assets. Okay. Now, this is a class about cash flow. And if you notice, I haven't talked about cash just yet, right? Well, why is that? Because we're starting with our right side of a balance sheet. That's the liabilities plus equity. So Bob's cash plus the bank's cash. And then we're spending that money on the left side of the balance sheet to create the business, essentially. And then we have $5,000 left to us. Okay. And that's how we ended up with that $5,000 at the end. All right. You notice Bob borrowed money. Okay. Bob borrowed money from a bank. So most of us, when we start a business, we're not always in a position where we have $50,000 laying around, right? Or maybe it's a smaller business and it's $10,000, or maybe it's a larger business and it's $1 million. We don't always have that money laying around. And so part of it comes from our own equity, our own cash, our own savings. Some of it comes from other people's equity, right? Maybe we sell a portion of our company. But oftentimes we're going to go to a bank or a place like AmPac, a CDFI like AmPac, and they're going to provide some debt for us. Okay. So what are some things we need to know about debt? Well, it takes effort to obtain a small business loan. That's what you all are doing now, right? Is you've learned how to plan, you've learned how to keep your records, you're learning how to manage your cash flow, but all of that translates into the business plan, what you're actually going to put together. Okay. We talked about credit score a couple of weeks back, and really I'm going to change that and say not necessarily credit score, but your credit history and how it is that you use credit. Okay. That matters when it comes to debt. Okay. And I think this is probably the most important one of all of these is make sure you get to know who it is that is going to be giving you these loans, right? There's some of the big banks are really good at doing these smaller loans, but you've been introduced to AmPac throughout this process. Get to know the folks at AmPac. If you're going to be seeking this type of deal, and whether it's AmPac or someone else, get to know who it is that you're working with, because these are folks that you're going to have a relationship with going forward, right? And they can tell you specifically what it is that they're looking for to help make sure that a loan gets approved for you. But at the end of the day, just remember, there's two pieces of growing your business or funding your business, right? Some of it's your own money, some of it is your own work that gets you to this point, and then some of it might be debt. And you want to make sure you get to know and put the work in, the effort in to be able to get that debt properly. Okay, so we're going to talk about 3 views of cash flow, the cash conversion cycle, cash flow diagram, and then a cash flow statement. Okay, so we're going to start off with the cash conversion cycle. Now, we're not going to get into things like ratios and all that kind of accounting fun stuff. Okay, we're just going to talk high level, what happens to our cash. Okay, well, in very simple terms, it follows along just like this. Let's get this laser pointer back out. We start with, well, and actually, really, you can kind of start anywhere, right? You can start anywhere on this little cash cycle. Okay, it could be that you're starting a business and you're paying directly, cash is going out the door, right? Just like Bob. Cash went out the door and he bought his ingredients, he bought his equipment, he bought all the different things that allowed him to run the business. Okay, so that money goes out. Business then uses those materials and makes something. Okay, so that's usually not cash is not moving when it does that, but now it has something to sell. And then it goes and it finds customers and it sells to those customers. Okay, well, now that the money has come in, right? Money's come in because they've sold. Well, now we have cash. We've used our coffee beans. Well, you know, I may be your regular customer on Thursday, so I drank last week's coffee beans. So you got to go out and buy more coffee beans, right? And so again, we pay for raw materials. Money goes out the door. We bring those raw materials in. We make what we need to make. We sell it, and that is our cash conversion cycle, right? Now, there's other things that go into play there. Of course, it's a very simplified version. So let's talk about the next page. This is a really cool little diagram or a good picture. It's this idea of buckets and leaks. And there's all types of places where cash can come in, and on its way out, cash can go kind of leaking its way out the door. Okay. So if you have your participant guide, turn to page 7 so you can follow along a little bit closer. Hopefully you can see it. But what are we talking about here? Okay, we're talking about at the top, something like the sales funnel. Okay, so sales bring in cash. So by the way, we're pretending that that the water in this case is cash. Okay, so what brings in cash? Okay, well, 3 things generally bring in cash. There's sales, or another way of calling that is revenue. Okay, there's debt. Okay, debt brings in cash, doesn't it? Right. So if I borrow money from a bank, or there's another way to think about debt, I borrow money from a vendor. So let's say in the coffee bean example, the coffee farmer is going to sell me a bag of coffee beans, and he's going to tell me, hey, go ahead and pay me in 30 days. Okay, that's called an accounts payable. Okay, so I owe that vendor, you know, whatever it is, I don't know, $100 for this bag of coffee beans. Well, that brought in cash, right? Because now I have the ability to sell those And so I've taken debt out, okay? Or it can be equity. In other words, just our own money that gets put in, okay? So then what happens to that cash? Well, some of that cash becomes immediately available. I'm going to switch to the highlighter here. Some of that cash becomes immediately available, and it goes right into the available cash bucket, right? The debt becomes immediately available. The equity becomes immediately available. But some of that cash, if we are selling, not necessarily in Bob's case, but let's say we're a manufacturer. Let's say we're a truck driver. We own a logistics company. And now we're the vendor that's going to their customer and saying, well, I'm going to go ahead and move these goods for you. I'm going to put it in my truck. I'm going to move it from here to there. And then here's the bill, and you owe me the money in 30 days. Well, we are now the bank, and we're issuing credit, and it becomes an account receivable. Okay. And then what becomes important about an account receivable? Well, now we have to collect on that account receivable. We have to make sure that we have a process in place to collect on those accounts receivable. But notice right here, well, sometimes maybe they're not going to pay us on time, right? Maybe there's going to take, so that's what we call bad credit. And so now we already have our first leak. So we just got started and we have our first leak of cash. And these are some of the areas. And as you go through it, I'll stop right there. But as you go through it, and I'll just start pointing out some of the high points here. We can bring a lot of cash in, right? But along the way, there's little leaks, and there's little places where we have to spend money. And then there's little places where we kind of lose a little bit, right? Here's a good one here, inventory, right? Inventory, we bring cash in, we buy inventory, and then we have to sell that inventory to bring more cash in. Well, along the way, some of us have a problem with obsolescence. What does obsolescence mean? It means it went bad, right? So imagine, for example, if you sold cell phones. I don't know, this is an extreme example, but let's say, for example, you sold cell phones and you sold BlackBerry cell phones. You were just the best at those old BlackBerry cell phones, right? Everybody loved them. They had the little keyboard. Well, and you went out, you spent, you know what, I'm going to buy 20 years worth of inventory because I'm going to get it at a real big discount, right? So I'm going to buy a lot of it so that I can pay a little bit per unit. This way I'll make a bunch of money. Well, if you went and spent all that money on those BlackBerry cell phones, where are those today? Well, they're sitting in a warehouse somewhere, right? Probably getting destroyed. And so cash leaked out because those things became obsolete. Could be shrinkage, right? Things go bad. If some of you that are in the food business, you know your food, you have things like spoilage. Some of you that are in the retail business, you know that maybe, some folks aren't always super honest, and that inventory has a way of finding its way out the door. Okay. Other places where we lose cash, right? We have to spend money on our employees. We have to spend money on our materials. We have to spend money on direct costs. So that's things like our rent for our office space. Okay. Other places we have to pay taxes, right? We have to pay Uncle Sam, whether it's payroll tax, whether it's sales taxes. We have to service our debt, just down here in the bottom right corner. Okay, service our debt. So in Bob's case, we borrowed that $20,000, and then about $300 a month roughly has to go back out the door to pay for that debt. But not all of it is going to pay the principal down. Not all of it is going to pay the $20,000 down. A good chunk of it is going to pay the interest down, right? So that's another place where cash leaks out the door. Okay. We have to buy assets, fixed assets. So that's, in Bob's case, that's our kitchen equipment. In the future, his stuff may become, he may need to buy a second coffee machine because his orders pick up. So he has to spend cash again buying fixed assets, right? This could be for some of you, it could be just about anything. It could be anything from office equipment all the way up to huge machinery. I don't know, a laser cutter that allows you to make a product, okay? And then finally, we have things like income tax. Depreciation, we won't get into so much. That's more of a so it's a tax strategy, and that's a tax thing. Talk to your accountant about that for those of you that have fixed assets. But I like to think of depreciation this way: is after a certain period of time, those things that you bought that are supposed to last you more than a year, those fixed assets, at some point you have to replace those things, right? So I like to think of depreciation. By the way, nobody does this, but just in the back of your mind, think of depreciation almost like, well, that's the money I should be saving because someday I'm going to have to replace this equipment. Okay. Most people just think of it as, well, it's a way to reduce how much I'm going to pay taxes on. That's fair as well, but something to think about. So in the banking world, we call that capital expenditures or CapEx. Okay. So we have all these places that cash comes in, all these places that cash goes out. Okay. So in a second, we're going to go and we're going to take a look at, we're going to take that image and we're going to actually show you where all that cash went. So if you have your participant guide, please turn to page 10 so that we can get ready for that. And while you're doing that, here's some of the things that that I want you thinking about. Okay, how much money Bob has to actually run his business. Okay, how much money is moving in and out of the wired cup? Where's the money coming from? Where's it going? And when that money is moving, when the money is moving in and out of the business. So when is a really interesting question as well. Okay, all right. So this is on page 10. I know it's a little hard to read on the screen, so hopefully you have you have it. So in this example, Bob made projections based on 2 months of actual experience in August and September. Okay, so projections are always great if we can imagine what's going to happen. But as we have actual experience, it's helpful to start plugging in what actually happened when we did, because that helps us be better planners, right? What's happened in the past gives us a starting point or a gauge for what might happen in the future, okay? Because remember, at the end of the day, projections are really just our best guess, okay? We'll talk about that in a second. So he doesn't know how much seasonality he's going to have and how much it'll affect his business. So he's making some guesses on the impact. So let's talk about seasonality. So if you remember from the example, Bob's business, the Wired Cup, is on a college campus, okay? Well, what happens every summer at college campuses? Forget about last summer, because forget about college campuses the last 18 months. Traditionally, what happens every summer on a college campus? Everyone goes home for the summer, right? We call that seasonality, okay? So seasonality means that you don't have a consistent month over month general sales. There are certain times of the year when those sales dip or drop off significantly, okay? Or vice versa, you can have the opposite, not problem, but the opposite benefit, where there's certain months of the year where sales significantly increase, okay? That's called seasonality, right? So some of you, that's something you want to think about, okay? You know, I didn't get a chance to look at the businesses that are on track today, but I'll throw some out. Let's go with a simple one. Ice cream shops, right? So you know, if you're an ice cream store, you probably have okay sales most of the year, and then right around this time, as it starts to get colder, your sales start to drop a little bit, and then the time that we just came out of the summer, guess what? Everything goes up. So there's a real seasonality in a business like that. Okay. So let's go through this real quick. Okay, so the first column here, that column is the startup. Okay. Actually, I'm sorry. It's first column. By the way, all of you are going to receive a blank version of this in Excel so that you can actually either recreate this or maybe even start plugging in some of your own business into something like this. So we're going to go through how this sheet works. All right. So the first column, that is the different categories. Okay. I remember the first time I started a business, you know, I knew a CPA and I got QuickBooks and you know, they kept telling me about, like, well, as soon as you open the QuickBooks, call me because I need to tell you what accounts you need. And I was like, accounts? Like, what are you talking about account? Like, you mean like my credit card account? You mean like my bank account? Like, I have a savings account. Isn't that what you mean? And he was like, you know, and then I ended up figuring out what he meant was he meant that all of the different categories of things that we're going to be spending money on. Okay, so that's this first column here, is all of the different categories. So you see at the top, that's money that's coming in, and at the bottom, that's money that's going out. Okay, and then we end up seeing down at the bottom what the cash balance is. What did that inflow and outflow end up meaning to the bottom line? Okay, and where will we start the next month? Okay, so the second column, that's here, we'll change the color for the second column. Let's go with red. So the second column here, I'm just gonna kind of highlight that. I really wish I had one of those little pens, right? Like an iPad. So that's the money. We already talked about that. Remember, we talked about his opening day balance sheet. Okay, so I'm going to give you another little extra accounting stuff here. Okay, all of your financial statements tie in together. Okay, so a balance sheet, okay, that's where you start your profit and loss statement, your income statement. Okay, that goes into and feeds into what your balance sheet is. Right? And then the two of those together actually tell you what happened to the cash. Okay. Now you don't need to know that. That's for your accountant and your financial advisors to kind of help you out with that. But this is an example of how that works. So we took in the $50,000. Okay. Some of it was debt, some of it was equity. And then remember, we went to the left side of the balance sheet and we started spending all that money. Well, guess what? That's going to also come right in here into our first column and get us started for where we are. Okay, what did we spend? What money came in, right? So that was the 20,000 debt, the 30,000 capital or equity. We had 50,000 to start. We spent all of that money there. Okay, we're left with $5,000. So these are all kind of the current assets, or the top of the left side. This is the bottom of the left side, the fixed assets, right? And then we're left with $5,000. Okay. So how do we do cash flow? Well, we're going to take that $5,000 that we're left with, and let's make it blue now. Okay, we're going to go and look at that. Pop right back up to the top, $5,000. Okay. So now what happened? This is actual. Okay. Bob went out and he had right about $31,000 of sales. Spent a bunch of money, right? In August, 29,000. So 31,000 came in, about 29,000 went out. Okay. And we end up with a new cash balance of $2,300. Okay. So we started with 5. Actually, hold on. I'm sorry. I made a mistake. Sorry. We started with 5. We had 25,000. Of sales. We collected $1,500 of sales tax. We have $31,000 in the bank. A bunch of money, 29,000 went out the door in different expenses, and we ended up with $2,300. Okay, so we started with 5. We're now down at 2,300. Okay, were we profitable? Yes, but were we cash? Did we actually cash flow positive? In other words, did we actually accrue cash? No, right? This is why having adequate working capital. So I just showed it to you in 1 month. Imagine if Bob had $0 instead of 5,000. Well, he'd be in the hole instead of $2,300 to get us started in the next month. We would actually have had to come up with, $2,700 or so. Okay, we would actually had to scramble and find that. So that's why this beginning balance, this beginning cash, is so important. Okay. So guess what happened in the month? So that was August. Guess what happened in September? Now we took that $2,300. We come right back up here. We now have a new beginning balance. Made some sales a little bit better this month, right? 27,000 instead of 25, but we still had very similar expenses to the prior month. We're down to $1,200. Okay. So now we start projecting out. Okay. But if you notice, wherever you end up, that's where you start the very next month. Okay. So let's talk about just a couple of comments here from the notes. Some of the cash outflows, if you notice, are month to month. Okay, so that's, for example, let's see, I'm just going to find it here on my big screen. So his lease, for example, that's right here. So his lease, that's a fixed cost every month. Every month he's got to pay $1,350. No matter how many sales he made, we have $1,350 that's going to go out the door. Some of them, though, are variable. Some of them are going to change, right? So that's ingredients. So this is where projecting out what we think we're going to do in sales is going to drive some of these variable costs. Because if you notice, as we go across the ingredient column, month over month, it's a little different, right? Sometimes it's 5,000 in one month, it might be 6,400 in another month, and oftentimes we're buying for next month's, for most of your businesses, you're often buying for next month's sales, okay? So it's kind of like the more you sell, the more you have to buy, okay? So some of those things, that's what we call variable expenses. We can kind of turn them on and turn them off, okay? But overall, Bob's pretty happy. The Wired Cup's doing well, right? You do notice here, if you looked ahead, we're going to end up in some trouble, okay? But the business is generally doing well. Through 2 months, we made a little bit of money. We had enough working capital. We think we're going to maintain that working capital. But now we start to project out what's going to happen. So this is the next thing that I want to share with you is that when you do this for your own business, I was actually taught this a long time ago, an attorney. I actually was taught this from an attorney, not from a finance person. And in that case, I was putting together a partner agreement with someone, okay? And we were going to go into business together. And the attorney said, okay, so we've written out our operating agreement based off of your plan and what you expect to happen. I said, yes, we're happy. Good. Okay, great. And he said, okay, now we're gonna rewrite it for just in case the worst case scenario happens. Well, what do you mean? Well, what happens if you end up in an argument? What happens if things don't work out? Then what? How are you going to work this out? And so we did a worst case scenario. And then we're high-fiving each other. We're like, okay, we're done now, right? He says, no. What happens if the best thing possible happens? What happens if you're successful beyond your wildest dreams? And one of you wants to go and retire, and the other one says, no, let's double down and let's grow even further. We're going to make a plan for that as well. Okay. The same principle applies to your projections. You're going to have a best case scenario, or you're going to have a most likely case scenario. Okay, this is what we expect to happen. But then along with that, you also want to create a best case scenario. And you might find that in a best case scenario, you actually grow a little too fast and you start running through too much cash. And you say, ooh, actually, I don't want to do that best case scenario. I need to actually kind of pump the brakes on it a little bit, or I need to borrow more money, or I need to bring more capital in. Okay, sometimes that happens. Or in a worst case scenario, what happens? Okay, usually you're going to build off of your most likely scenario. Okay, but it's important to know that you're thinking through what happens if I'm way off, right? For some of you, that might say, well, I expect my sales to be, at X, right? Let's just say $25,000 or $30,000 a month. But I'm going to plan for 25. What happens if I do 25% better? Then how do all these numbers work out? Right? Maybe you start growing like gangbusters and you don't have enough cash to buy because the cash hasn't come in yet. And you don't have enough to buy your inventory for the next month. Ooh, we got a problem, right? Some of you might say, okay, well, so let's say 25,000 on the upside, or 25% on the upside, 25% on the downside. I'm going to plan for that as well. Ooh, can I stomach that? Okay, if it gets that bad, what's my plan to be able to find the capital that I'll need to keep things going? Okay. Overall, let's go back to this here. So Bob's making his plan, and remember we talked about seasonality a second ago. Well, there's our seasonality right there. Okay. So in June and July, in the summer, he's expecting sales to go down. He doesn't know how much, but he says, well, you know what, if it drops about 25%, here's where I think I'll be. Yes, I'll save a little bit of money, right? Yes, I'll save a little bit of money in inventory, but most of my other fixed costs are still going to be there. And I still have to pay this debt back, right? So loan principal and loan interest still has to be paid back. And if you notice, and this is where we kind of started a second ago, we actually end up in a negative cash position. So overall, things are good. And the good news is that we're a year away from this happening, right? But it's important to know that this is something that we have to prepare for. All right, so what are some things to think about? And I think this is a place, maybe Brian, if you can kind of take a look. Let's get, what would you recommend in this scenario that Bob did? Here's some things to think about is there a way to increase sales revenue? So put into the question and answer box, and then Brian, maybe just pick out one or two. what would you recommend if you were Bob's advisor? What would you recommend that Bob do? Could it be that he increased sales, right? Could he try to go to his vendors and try to get ahead of that seasonality and see if maybe he can buy some more in bulk when times are good? Are there ways to maybe boost sales and I don't know, do something during those seasonal up and downs? Do you think he should maybe, I don't know, get a credit card and pay for some of these things on a credit card so he can push off some of his cash flow issues? Give us your thoughts. What would you do?
So I do see a couple folks popping some responses
Okay.
into the Q&A box. Kai,
Good. I want to hear what folks would do.
so we do have one recommendation: sell whole beans through online sales, sell to corporate accounts. Love that as a thought. Lower hours.
Hold on. Let's back up. So sell to corporate accounts. Okay. So selling to corporate accounts, great idea. I love that because now we're diversifying our businesses. But oftentimes, corporate accounts are going to expect that we carry some trade credit for them. In other words, I'm going to ship you the coffee first, and then you're going to pay back. I'll pay you in 15 days or 30 days. So that's something to think about, right? Because that's a little bit of a different cash flow. So yes, great idea, but we have to be very cognizant of what that's going to mean to our cash. Ideally, we can get those corporate accounts to pay us upfront, right? Cash on delivery, but sometimes that's not going to be a case. But I love the idea. So what were some of the other ones?
So we also had a recommendation for increased sales through add-ons. We also had a recommendation.
Great idea. Like add-ons? I'm assuming you mean like selling, whether it's I don't know, the more bakery goods, or hey, you can buy Bob's coffee mug, right? Again, great idea, but remember we're talking about inventory. That also means additional expenses for inventory. Okay, so from a profitability perspective, you're probably 100% right. That's something Bob should absolutely do, but we're probably going to need to raise capital to be able to buy the additional inventory to offset that, okay? And so then we start to think about where we're going to raise that capital. So good. What's another one, Brian?
So we have a good couple. So I'm gonna try to read them off from where I was, which was from the first one. So we also have lower hours for employees as they see payroll remains consistent.
Absolutely, love that. I mean, look, you want to keep people employed, right? But you're absolutely. Hey, if the business is slowing down, let's find a way to save some money on the employee costs. That's look. Unfortunately, that's oftentimes it's an easy one to go to. In this case, I think it absolutely makes sense. In some cases, it's maybe we could find another way to do it. But that's a great suggestion here.
I do see Hilda. Do you have your hand raised?
Nope, not intentionally.
Oh,
Keep going.
All right. Another great recommendation we had is, could he lower his payroll by staffing less due to the slow seasons?
Yeah, during that time, absolutely, love that.
And
Well, I
then-
like that. I see one, monthly subscription plans. That's cool. Give somebody a discount, right? Give somebody a discount to say, hey, meet your coffee of the month club or something like that. That could be a really good idea. Why? Because there's not really a big cash outflow to get something going, right? So the timing of your cash is a little different. Maybe your sales go down, right? To your, I shouldn't say that, your sales maybe not, but like your average sale per customer might go down, right? But it's still in your same kind of the pipes, right? The pipes are all the same, right? We're not changing the pipes, right? So I really like that one.
Yeah, I like that one too. I also saw one that I thought was cool. Negotiating deals sounds like a good idea, but looking at how you can create or pivot offers. So trying to adjust what your cash flow is from your initial offer.
Mm-hmm. Yeah.
Wow, you're covering it fast. I love all the recommendations, all the thoughts. This is awesome engagement, you all.
Yeah, this is really good. I really like this Wi-Fi marketing. Yeah.
And someone
Yeah.
said rent out space to host events.
Oh, okay. Perfect example. I actually have one of my customers. I'm glad you brought this up, Hilda. So one of my customers, if you have Instagram, they're like super famous on Instagram. It's I think they have two stores. One is Horchateria. So for those of you that know horchata, so horchateria. it's honestly, it's just like this business, like the most amazing coffees and pastries you can imagine. And then there's another one called Donas, which is donuts, but in Spanish. So Donas. Look them up on Instagram. They're just really, really neat people. But so if you want a good coffee or good donuts or bakery, go to them. But that's actually the one of the we did a loan for them to move kind of their original store that they bootstrapped, very similar to what to the Wired Cup here. And we gave them some money, and they moved into this bigger place. Really, really spruced the place up, made a beautiful little location. They have a drive-through now. It's great. And then they have other stores. That they have other stores. Well, they have space in that location. And they bring in artists, and they bring in, they do events there. They do all kinds of stuff. So in their case, they don't really have the seasonality problem that Bob has, right? But they're using their space in a really wise way, right? So that's a really, really good one. Is that oftentimes you can rearrange space and then bring in other folks, right? So in this case, maybe during the summer, clear the tables out, rent the space out, and do other things for the folks that are still around for the summer. So any other good ones, or should I move on, or can I move on, I should say?
We're at 2:00 already. I think we should push.
Okay. Possible ideas for Bob. This is just right from the deal. Here's another one we did. I didn't see this one. Is start increase revenue. Yeah, duh. Right. Yeah. Hey, sell more. Yeah, that solves everything. Okay. This is not my training. Start catering. This is from the FDIC. So anyways, I'm joking a little too much here. Start catering. Great idea, right? Some of you said something along, corporate customers. That's kind of along the same lines. Love that. Sell gift cards. I kind of saw some things along those lines in the suggestions as well. That's an idea. Landlord, hey, pay entire year's rent in 10 months, not 12. We already know sales are going to be down and just cash is going to be tight in 12 months. So it's almost like going to the landlord and saying, hey, you know what? How about I just increase my rent on all the months that I am in business? And it helps me just manage the cash a little bit better during those slow months. Reduce costs during slow months and staff, right? We got a lot of those. Reduce menu options, right? So again, this is kind of that last one is kind of the opposite of some of the great suggestions that we had about selling other things. While selling other things is great for profitability and it's great for revenue, it's not always great for cash flow, right? We need some investment before we can do those things. Well, the opposite is true. If we actually take things off the menu, there's less cash. There's less of a outset of cash, right? There's less of a cash need on the outset. Okay, so that's another way to manage some cash. Okay, what not to do? Do not postpone paying estimated taxes. Remember we talked about that last week. Okay, about paying your estimated taxes. Do not hide from loan officers. If you borrowed money from a bank or you borrow money from a CDFI like AmPac and they call you and things are tight, pick up the phone. I know you don't want to have that conversation, but it is in their best interest that they help you. And we see a lot of things, right? By the way, this is also a reason to do business with people you like. Okay. Some of us tend to, hey, and I'm just as guilty as this as anyone, we tend to say, oh, there's the cheapest, right? There's the easiest. But sometimes we want to be able to do business with somebody that we know, that we have their phone number, right? So that's important. Okay. Get a hold of them. Do not pay vendors late. Why don't we want to pay our vendors late? By the way, I didn't see, and no one here gave us any of the what not to do. So that was great. We don't want to pay vendors late because then they'll stop sending us supplies, right? Or maybe they'll start charging us more, or maybe all of a sudden they will they'll start saying, you know what, we were offering you credit, we're not going to offer you credit anymore. Okay. Do not overestimate. Or overestimate revenue, underestimate costs. That's another way of saying sticking your head in the sand, right? Let's be realistic about what's going to happen, because if we're realistic, we can plan for it and we can overcome it. I don't remember seeing it on the what to do. Yeah, here you go. Sorry. So I did want to point this out. So in this case, for some of you who are that are in the retail sales type of things, that is something to think about is, can I get trade credit? Can I get credit from my vendor? We talked about that earlier about saying, well, you're going to send me the coffee now, or you're going to send me the flour now, I'll pay you in 30 days, right? That's a whole different thing to manage. You want to make sure that you're doing an even better job of managing your cash flow, because when that bill's due, you got to pay it, right? But that's a great way, oftentimes, that's a heck of a lot cheaper than doing things like, borrowing on a credit card at 25%, or getting one of those, I don't know what we're calling them, merchant cash advances. I think they're being called. I think that's the nice way of calling them now. The fintechs of the world, loan sharks. I didn't say that though. But be careful. That stuff can get really expensive really fast. Okay. There was one other thing.
Omar, my rule of thumb is if it sounds too good to be.
Yeah.
Could you hear me? If it sounds too good to be true, it is. So really be careful.
This is why I love doing business with Hilda, because I say things, she says things in much, much better ways than I ever could. So be careful with some of those vendors out there. Something I was supposed to bring up earlier that I think I missed it in my notes is sales tax. So we talked about sales tax, and you saw in the cash flow that we are collecting sales tax, right? That's cash in. Okay. So in fact, I'm going to go back. I'm going to show it to you all on the chart. Okay. So sales tax, very important. Let's get the highlighter back out. Okay. Sales tax, collection of sales tax. That's that line there. Sorry, this line right here. You see it's like $1,500. Okay, that's not your cash. That is going into the bank account, and it is boosting the level of the bank account, but it is owed to someone else. You are not earning that money. You are collecting it on behalf of the government. Be very careful with things like sales tax, with things like payroll tax, okay? Because those are things where, say what you will about the system, you're collecting it on behalf of your state and local governments, and it's their money, and that stuff gets real expensive if you don't pay it on time, okay? That's like put you out of business type stuff, okay? Okay, we talked about what not to do. It is professional to ask help. Okay, it is. I've brought this up a lot. Seek out expert technical help. You have a plethora of it with AmPac. Make sure you're working with qualified accountants that can help you manage this. And I'm going to make a really quick comment here. Maybe Hilda can find the better way of saying what I'm going to say. Your accountant has a greater role than just saving you on taxes. Okay, you should be getting more from your accountant than just how do I pay less tax. Okay, is there a nicer way of saying that?
I think you said it perfectly. They're part of your bench. So we started the webinars talking about building a team, building a group of trusted advisors, and your accountant needs to be part of that and having some dialogue with you about some of these practices that we talked about, and be part of your trusted advisors.
Absolutely. Absolutely. And here's another one. I talked about this at the beginning as well. Share ideas with other businesses, other business owners. You should be friends with other business owners, right? Whether it's at networking events or, there's Rotary clubs, there's, I'm blanking on the I'll think of it. I'll think of it before that. But there's clubs, right, of business owners.
Yeah. Chambers.
There you go, chamber. That's what I was thinking of. Where you can come together and say, you know what, I'm having this issue. What did you do when you had that issue, right? There's really great coaching organizations, peer coaching organizations, where you have usually somebody that's retired or close to retired, and then you just filled in a room with other business owners that they've either gone through what you're going through, they will go through what you're going through someday, or they're going through something that you've gone through, and it's a great way to support each other, right? I love that word there. It's not competition, it's co-opetition, right? Even other people that are in the same industry as you. Go ahead, Hilda.
You know, Omar, that's really why we built the app, and Brian was really passionate about creating an opportunity for people to be able to talk real time as business owners. So on the AmPac app, there's an opportunity for people to continue to dialogue and ask each other questions and get some advice or just some other thoughts. Have a brain trust that you can bounce things off of.
Absolutely. Absolutely. Yeah, that's such a great point. All right, key things to remember. Managing cash flow is a core competency of your small business. This matters, right? There's a lot of, what's in the bank, you can't just open your bank account, say X amount of dollars in there, I'm doing well. Really, this class really kind of ties in everything that we've talked about up until this point. Okay, we start with planning. We keep good records, right? Because by the way, we can't manage our cash flow if we're not keeping good records. Okay. Number two, an opening balance sheet tells a compelling story, and this is something I'm going to challenge a lot of you that are existing business owners on. There's oftentimes that myself as a lender, I'm asked to finance something. Sometimes I'm asked to finance a change of ownership, like a partner buyout, or hey, I want to buy another business, or I want to buy this business, or whatever the case may be. It could be I want to buy equipment. It could be any working capital, whatever. And I'll ask, okay, great. Hey, so when we fund the loan, what's the opening day balance sheet going to be? And 9 times out of 10, I get like the blanks there. Okay. What does that mean? It means that when this thing changes, when this event happens, now what? Where are we going from there? Because if we don't know where we're starting from, it's really difficult to project out. Okay. So an opening day balance sheet, I'm gonna just kind of challenge everyone that as you go forward, and as you, if you don't have a balance sheet, let's fix that. Let's get a balance sheet, because that's important. That is your business, right? But if you're planning a big growth, if you're planning an acquisition, if you're planning some sort of major change, if you're bringing a partner in, if you're buying a partner, some sort of big change, you should be able to sit down from a planning and from a decision-making point of view and say, okay, when I do these things, what's the business going to look like then? Okay. Cash flow statement then continues that story. We're looking at actuals, and then we're projecting out for the rest of the year. Okay, that's how we use that cash flow statement. We want to plan for seasonal fluctuations. If in fact your business is seasonal, we talked about what that looks like. Okay, I'm going to add in, we're going to plan for growth, right? Because everyone here is hoping and planning for growth. So we're going to plan and project out, well, what happens if we really do grow, right? What does that mean to our cash? You may find it doesn't look very nice, and you have to find other ways to make sure that we're properly financing the business before we grow. Okay. We want to maintain a rapid cash conversion. So that's that money coming in versus the money going out, right? That little triangle, okay? We want that to be as fast as possible. Manage your paperwork like a pro. Refer back to last week, record keeping. Ask an accountant for advice. Okay.
Omar,
and then finally, yes.
Omar, I just want to ask I thought a really thoughtful question. I think the name is Casey. And she asked this question because it's it's different for industries and rule of thumb. So she said, when should a business be able to sustain itself and have money to pay all overhead without looking like it can't sustain a bad month? i.e., starting a month with around $2,500 when you have staff to pay. After 1 year, I would think this business is not making it. So since this is your example, thinking about what you showed in that slide where they had 5,000 in cash, made cash, and then ended up with 2,300. So since this is your example, I think you see things differently than me. So when should a business know it needs to stop, it isn't going to make it, or where is the point where you know you will make it because you have enough cash flow coming in each month? For example, is it gross? 3 times overhead means you probably will financially make it, Or what is it by when date? Several months, a year? Can you give her some advice on that?
Yeah. So I don't think there's a specific when. There's a by being 3 years old, you should be at X. I also don't think that some magic ratio is going to really do anything for anyone in that case. What I would advise someone like that is, let's go back to the planning stage. Let's start with, okay, let's recognize where we are, plan and project out for where we're going to be, and then be a realistic about what that looks like. And what I would say in Bob's case is, so in that specific example is, if that's your best case scenario, I'd like to see your worst case scenario, and I'd like to have had you put in more than $5,000 to start, or more than the 30,000, the 50,000 combined. And I would have liked to have seen that be a little bit higher from the beginning, right? Because we recognize that because of the seasonality, we end up in a bad spot at the end of it, okay? Well, it is what it is. We already had the 50. Okay, so now where are we? Okay, so now we're in September and we know that a problem is going to happen. Okay, so again, we know where we are today. We're projecting out to where we're going to be. We're recognizing a problem, and then now what can we do? And that goes back to that slide of, here's all these things that we can do to be able to avoid that. Okay, so it's hard to say, okay, when's a business ready? Okay. I think it's easier, it's more appropriate to say, where is the business today? Where do we expect the business to be at some point in the future? And then what are we going to do to make sure that we A, arrive there, and B, are addressing the problems that are going to come down the road. Now, we can fast forward this and say, okay, what does a mature business look like, right? Again, a lot of different ways to describe mature businesses, right? It could be revenue, it could be profitability, there's a bunch of ratios, there's, so on and so forth. I like to think of it like this, right? Is building a fortress balance sheet, okay? That's, by the way, we keep going back to this balance sheet thing, right? So maybe that's an important thing for folks. If you don't have a balance sheet, you should be working on this. But what do we mean by a fortress balance sheet, okay? Remember what I said earlier. I said left side equals the two parts of the right side. So assets equal liability plus equity, okay? Well, we want the bulk of that balance sheet to be in this part, the equity part, okay? So this is our assets, this is our business, okay? What makes up, or how we're funding that, is coming from that equity. Where does equity come from? Equity comes, yes, from the cash that we put in, right? But more than that, a maturing business, equity comes from retained earnings, the money that we are not taking out, right? And we're leaving that money in the business as it grows. Certainly, a business owner is not in business to not make money, right? No one goes into business to maintain their status quo, right? Business owners go into business because they're trying to build their wealth in, and whatever that means to that particular owner. However, if we make, gosh, I can literally give you specific examples from earlier today, but let's just say we make $1,800, right? And we have $2,500 in the bank. Okay, should we pull out all $2,500? No, well, then we're not going to leave the business with anything. Should we pull out $2,000? Well, no, because now we're not retaining any of the earnings, right? So if we're making a certain amount of money, we've got to leave something in there so that the business can continue to grow and the business can continue to mature. So I didn't answer your question specifically, but hopefully I gave you some good comments there.
Thank you, Omar.
Yeah. Did I go the wrong direction? Okay.
No, I hopefully it helped. I thought it did.
Yeah. So, all right. Toolkits or resource. I'm gonna hand this back to Brian because you're the one that's gonna be sending the email. So maybe you can go through what they're gonna be getting after the class.
Thank you, Omar. So we will be able to send out, we're going to recap the program requirements, everything that is already listed on the website, and we will send out the homework assignment for today's session. Just because this was the last one, we'll be sure to include the participant guide from each of the sessions and the homework assignments for each of the questions. So we will aim to really make sure you get all the information you need. We are trying to respond to as many people as we can, but there is a high volume, so we will be limiting our responses. But please be on the lookout for the grant award winners via email. Thank you, and we are so grateful to have you today.
Okay, and thank you again, Omar, for the outstanding training, for the dedication of your time and that of American Business Bank and offering the training as well as the grant. We know there were several questions, several repeat questions, and I think the question that I answered most during the webinar is whether I can still apply. And the answer to that is if you've attended two trainings, at least two trainings, and you complete the assignment along with the other aspects of the application, you can absolutely still apply. There was may have been some confusing language that people read in the overview of who should apply or not apply. Again, the requirements are you complete the application, you complete all of the forms, and you complete at least 2 of the 3 trainings that are offered, and you complete the assignments that go along with that training. So if you complete all of that, you will be in the pool for the scorecard, and then we will make announcements on October 20th. There is to receive everything that we've asked, including the training. The deadline is October 11th. So make sure everything is in by October 11th. All of the information, as Brian said, that we've covered in the webinar, along with copies of the YouTube videos, will be sent to all of the participants today following the webinar. We thank you again for attending. You're certainly welcome to go to the AmPac website at ampac.com, www.ampac.com. This video will be posted on our YouTube channel, and we certainly wish all of you the best. If there's other things that the AmPac team can assist you with or other loan programs, we'd be happy to do that as well. Again, thank you very much for attending.
Hilda, actually, you can stop the recording.